Planning Alliance.
This is Lindy Carroll with the Social Impact Research Center at Heartland Alliance.
We're going to be... Sorry, go ahead.
This is Kristen Shelf from Justine Peterson.
Hey, Kristen. We're going to be beginning in about 10-15 minutes.
Okay.
everyone, this is Lucy Milani with Heartland Alliance. We're going to begin the web seminar in just a couple minutes. We're going to wait so a few more people can join us. Thanks. Hi, everyone. I think we are going to get started. So this is Lucy Milani. I'm a Senior Policy Associate with Heartland Alliance, and I serve as the coordinator of the Illinois Asset Building Group. Welcome to today's webinar, How the Game of Credit is Perpetuating the Racial Wealth Gap. Just as a quick overview, IABG is a statewide coalition made up of organizations that are really committed to increasing access to the tools that people need to build financially secure futures for themselves and for their children. Before we jump into our reports, I just want to go over some housekeeping very quickly. So right now, everyone but those presenting are on mute. However, if you do have questions that come up throughout the web seminar, please use the chat feature to type in your question, or if there are problems as well. We are going to have a Q&A section at the end, so just keep that in mind. And then finally, the webinar is being recorded, and we will make it available on our website, as well as send it out to all of you via email after today's session. So an overview of the agenda today, I'm going to introduce our wonderful speakers, and then we're going to get into an overview of the racial wealth gap. We're going to discuss some of our report findings, and then we're going to really get into solutions, so both program and policy solutions. So with us today is myself, which I've already introduced. We also have Carl Wiley, who's an intern with Heartland Alliance. He serves as a policy associate, and we are really excited to have Carl. He's been doing a lot of work for us on the history of the racial wealth gap and helping us better understand what different policies have contributed to the gap. We'll also be joined by Lindy Caro, who is with Social Impact Research Center, and I apologize if he has her name wrong on the slide, but Lindy is the lead researcher on the report that we're going to be discussing today. And then we have Kristen Schell with us from Justine Peterson. Kristen is a credit building manager with us, and she has really provided a lot of support to us as we better understand credit scores and credit building products. So there's two reports that we released today. One is entitled Trapped by Credit, and the second one is entitled Game of Credit, but there's really a lot of overlap over both of them. Some background, IABG has really been working on asset building and expanding access to the tools that people need to build wealth, to build financial security across their lifetime. And we can't possibly do that without thinking about credit scores and credit building. Credit scores have a huge impact on people's ability to build wealth, their ability to access safe loans, access different types of services that help them build wealth, including employment and housing in some circumstances. So we really wanted to dive into and better understand what credit scores look like in Illinois. And in doing that, what we found was a huge disparity across race. So that's what we're really going to be talking about today. And before we dive into the findings of the report, we do want to provide some context of what the racial wealth gap is, what it really means, and what it looks like in our communities. So to do that, I'm going to turn it over to Carl Wiley, who's going to discuss the racial wealth gap.
Thanks, Lucy. Hi, everyone. Thanks again for joining us.
Just to be clear, can everyone hear the audio? I'm just getting a few questions of that's not coming through exactly. If you can hear, could you please send out a chat or a question box? Okay, sounds great. Thanks.
Great. So what we'll do now is move next to talking about the racial wealth gap, what it is, and some of the policies and practices that have contributed to its growth over time. Then we'll kind of move into discussing the interactive timeline we've created, which kind of shows the progression and context of some of these historical policies. And then I'll kind of show how to navigate the timeline and ways that you can get involved and give us feedback to kind of help grow and shape the timeline as we move forward. But first we'll start off with what is the timeline, or what is the racial wealth gap. The racial wealth gap refers to the dramatic gap in household wealth that exists between white households and households of color as a result of government policies, institutional practices that have created different opportunities for groups of different races. This wealth gap refers to the existing disparity of wealth based on race. The wealth gap is rooted in and reinforced throughout U.S. history, throughout policies, and throughout practices that we've seen throughout the years. In present day, the racial wealth gap is seen primarily through a disproportional access to or barriers to credit. We can jump to already on the next slide. So the current state of the gap, one of the ways we see it as for every dollar increase in average income will only generate about 69 cents in additional wealth for African American households over the past 25 years, whereas that same dollar will bring about $5.19 for white households. Part of this equation is resulted from black households having fewer opportunities to grow their savings beyond what's needed for everyday lifestyles and for emergencies. Also, the gap is widest between white Americans and African Americans. It has actually tripled over the past 25 years as the graphic to the left, as you can see. And here we have a graphic representation of the wealth gap from about 1984 until about 2009. We can see in 2007 where the recession kind of hit in both white households and African American median net worth was actually seen to drop a little bit, but the gap is still fairly significant, as you can see on the graph. So why does the racial wealth gap exist? We've kind of touched on it briefly when we started, but there are certain policies and practices that have been created to systematically bar people of color from wealth-building activities. And so some of these some of these barriers include blocking people from accessing education, restricting land and home ownership, denying employment opportunity and employment-based benefits, and also created unequal access to savings and credit-building opportunities. And so we've kind of seen this throughout history. It's been perpetuated over and over again, and we'll kind of go into some of the policies that have reinforced it throughout the years. Sure. So what we're going to do now is we're going to actually jump to the timeline on our website here. So we're actually showing you how to kind of access it via our website, and I'll kind of take over and show you guys how to navigate the timeline. On our webpage, once you see the initial blog posting, you can see where it says check out the timeline. If you click on that, it should open up our timeline here. We've got a little intro text that kind of gives a little context to the timeline and gives you some setting information. So for the first policy, we're going to jump to 1934 with redlining, and I'll show you how to navigate the timeline to get to that posting here. We've got two ways to navigate the timeline. There's a slide bar at the bottom, so you can, if you click on it, you can just kind of drag through, and you'll see the events pop up as you go through, the timeline here. You can also click on specific policies, and once you click on them, it'll expand them out, and you can see the media to our left. You can see the heading here, the dates involved, some of the explanation text here. But you can also navigate with the arrow keys. If you just press left and right, it should take you to the different policies there. So what we'll do is we're going to jump to the first policy we want to highlight, which is redlining in 1934. So I can navigate over to it here. Here we are. So you can click on for more information. It'll bring it up for us here. And I'm actually going to click on the media so you guys can actually see the map while I'm describing part of the impact on the racial wealth gap. So redlining specifically refers to something that took place during FDR's time in office, during his New Deal proposals, where he created the Federal Home Loan Bank Board and the Homeowners Loan Corporation, or what's known as the HOLC, where they primarily work to refinance home mortgages and avoid foreclosures for individuals. Redlining here refers to actual red lines drawn on the map. You can kind of see here specific areas. They've been outlined and coded as red. Some are yellow, some are blue, some are green. And there's a key down here you can kind of see, and I'll kind of explain a little bit more about this here. But what this map was called was a residential security map. And this was used, it was adopted by other sectors including healthcare, banking, retail, supermarkets, and insurance providers. So if they were all using the same map and they were denying access to areas that were red and yellow, this created a disproportionate access for vital assets for these communities. These communities are primary areas of people of color living in those areas. Key examples of redlining included high-earning people of color being denied for loans that were subsequently offered to very low-income white individuals within the same city, oftentimes maybe several blocks apart. You can see at the top of the map there's an area of red right across an area of green, so this could be an example of someone being denied a loan, even if they were doing very well, but they existed in a red-coded area. So what we'll do now is we'll jump to the next policy we wanted to highlight. I'll just use the arrow key to jump over to, which is the Social Security Act of 1935. And I'll bring up the media. This is actually a government poster advertising Social Security. The primary impact of this policy impacted poverty and asset accumulation for individuals. Again, this was in 1935 under President Roosevelt, and he signed the Social Security Act into law, which primarily addressed poverty, economic security for aging populations, unemployment, and benefits for what they called widowless and fatherless children at the time. At the original outset of this legislation, it was aimed to bring stabilization and security to populations that were particularly vulnerable. However, some groups were systematically denied access to receiving these benefits. Initially, farm workers and maids were excluded at the onset of the act, which resulted in about 65% of African-American workers and 27% of white workers at the time being excluded from benefits altogether. This also included barring access for unmarried women and minority groups. And the way this can kind of be viewed, the Social Security Act was kind of a ladder to help people into safe retirement, into climbing out of poverty. But it was systematically denied to certain people, thus creating kind of a long-standing significant impact to the racial wealth gap. So what we'll do is we'll move on to our final policy that we're going to address in the presentation. There are a lot more on the timeline. You can explore it kind of on your own. It goes into much more detail. But we'll jump to the Civil Rights Act of 1964. I'll kind of expand that event here for everyone to see. And I'll bring up the media too and kind of go into some more detail. The primary impact of the Civil Rights Act of 1964 was actually a benefit to individuals in accessing education and employment. This is one of our beneficial policies we're going to address today. So the Civil Rights Movement throughout the late 50s and 60s represented one of the largest social movements towards racial equity in our nation. It was signed into law in the summer of '64 and primarily outlawed racial and ethnic discrimination based on, with attention to school, workplace, and voter discrimination. So with these policies effectively, this discrimination banned, minority groups began seeing an increased access to social assets and social capital in areas they weren't allowed to access previously. In one particular area in the textile mills in the South, black employees of those mills went from about 5% in 1963 before the signing of this act to about 33% in 1980, and that was in South Carolina, and we saw this increase across the southern states. So minority workers were actually given access to higher wages and actually employment they weren't given access to before, and they were able to send their children to higher education and marked a significant shift towards asset accumulation for certain populations. One key note for this policy is that the rise in minority asset accumulation did not come at a cost to other racial groups. A lot of studies at the time showed that white employment and white graduation rates did not decrease as minorities entered the workforce and graduated from college. So it kind of just shows that there was a benefit for all and not a detriment to any when you kind of expand these access for different folks. So we kind of ended, I think, on a more beneficial policy here. One of the things I want to talk about, there are 36 other policies on here. And part of the timeline, we're trying to get feedback and kind of, have the timeline represent a living, breathing document that is changed by people who view it. So if you see anything particularly that we've missed or that we should include, there's actually on the previous page before, there's a text box to enter your name and kind of submit a comment so we can kind of update the timeline and make sure that it's includes all the data that we should have on there. And so what I'll do now is we'll kind of change over to Lindy, and she'll kind of go into more detail about the research on the credit scores and how it exists in Illinois.
Great, thanks, Carl. And this is Lucy again. Before I pass it off to Lindy, who's going to share some of the research findings from the report, I just want to let everyone know that in producing this report, we actually presented the initial data analysis to communities across the state to get a better understanding of really what the story is behind the numbers. And so some of the stuff that both Lindy, Kristen, and myself will be sharing was really informed by that. And you can get a list of the communities and the organizations that really helped us think through this in the report. Thanks. And I'll pass it off to Lindy.
Thanks, Lucy. So again, this is Lindy Carroll with the Social Impact Research Center. I'm not, in fact, a second Lucy. So just to get started, our report, well, we're actually releasing two reports today, but the report I'm going to be focusing on is the one named Trapped by Credit, Racial Disparities in Financial Wellbeing and Opportunity in Illinois. And like Lucy explained, our research looks at the disparity in credit scores in Illinois communities. And sort of the title sort of speaks to the two-way street that credit scores kind of represent. Your credit score is based on your past financial activity, so it may serve as an indicator of past financial hardship, but then it also contributes to your future financial opportunities. So racial disparity in credit scores not only speak to the financial hardship that communities of color are facing so far, but also yet another barrier they may face in trying to build financial security in the future, attributing to that relationship. So just to take a quick step back and explain how we define some of the concepts in our analysis, I wanted to give you just a couple quick definitions. So first, we use the term minority presence throughout this presentation and in our report. And basically all it means is the share or the percentage of people in a community who identify as a race or ethnicity other than white. So basically when we say that there's a high minority presence in a community, it just means that there's a high percentage of people in that community that are people of color. That information came from U.S. Census Bureau's American Community Survey data. And then credit score, Lucy already kind of touched on, so I won't spend too much time on, but basically your credit score is a number that's calculated based on information on your credit report, and your credit report contains information from your financial history. So yeah, there it is. So our analysis kind of looks at the relationship between those things. And the key findings from our report, looking at the data that I just kind of explained, our analysis shows that there's a strong relationship between minority presence and the average credit score in Illinois communities. We found that there were many other factors that also related to both minority presence and credit score, and some of the strongest of those relationships, and those that we saw as key to the story of racial disparity, were focused around education, employment, and home ownership. And then in the next slides, we're going to dive deeper into those concepts. First, I'll explain quickly what we're looking at. Each of these little green dots is an Illinois zip code. We've basically taken the average credit score. Here you can see the bottom. We've taken each community's average credit score and the minority presence and plotted it on a graph. That's it. And the red arrow just shows the trend that we're seeing throughout all of these different relationships, and they just clearly illustrate the relationship that we're talking about. So the main relationship we're focusing on is that between race and credit score. You can see clearly in this graph that areas that have higher concentrations of people of color, there are also lower average credit scores and vice versa. Looking at a few specific neighborhood examples in both Chicago and the St. Louis area, we can clearly see the stark disparity. In the Chicago neighborhood of Lincoln Park, where only 17% of the population is a minority, the average credit score is 734. In contrast, in Inglewood, where 99% of the population is a minority, the average credit score is 603, or 131 points lower. In the St. Louis area neighborhood of Belleville, 22% of the population is minority, and the average credit score is 707. In Washington Park, where 98% of the population is minority, the average credit score is 600, or 107 points lower. So jumping into the related factors that I mentioned earlier, we're going to first look at education. Based on what we know about the link between education and income, the racial disparity in education, it isn't a huge surprise that education level is associated with both credit scores and minority presence. Higher education levels are related to having lower unemployment rates and higher income, so it makes sense that the higher education levels are also related to higher average credit scores. So you can see in this first graph that in areas where there are higher concentrations of people with a bachelor's degree, that's how we're defining high education level, the average credit scores are higher. We also know that a disparity in access to education has caused an educational gap for minorities. Since public school funding in Illinois is heavily funded by local property taxes, schools in poor areas tend to have fewer resources for their students. These are things like less access to advanced placement classes, college guidance counseling, and after-school tutoring. And all those things contribute to a pattern of lower minority high school graduation rates. And minority students disproportionately attend these lower performing education or elementary, high schools, and elementary schools in areas of concentrated poverty. So this disparity in access has long-term impacts. And although the number of minorities pursuing and completing post-secondary education has increased over the years, the share of minorities possessing a bachelor's degree or higher is still lower than that of their white counterparts. So we can see the relationship in the second graph over there sort of shows it shows that in communities of color, the share of people with a bachelor's degree or higher is smaller. And closely related to education levels is the amount of student loan debt that people have. And we also see that there's a pretty strong relationship between the amount of student loan debt and average credit scores, as well as student loan debt and minority presence. So looking again at the same neighborhood examples that we looked at earlier, we see that in addition to these stark disparities in credit scores, there's also a pretty big gap in education levels and student loan debt. In the Chicago neighborhood of Lincoln Park, 82% of the population has a bachelor's degree or higher, and the average student loan debt is about $9,600. In contrast, in Inglewood, only 7% has a bachelor's degree or higher, and the average student loan debt is around $5,000. So that's a huge difference. We also see a pretty big gap in the St. Louis area. In Belleville, about a third of people have a bachelor's degree or higher, and the average student loan debt is about $6,500. In Washington Park, only 4% have a bachelor's degree or higher, and the average student loan debt is only about $4,500. Employment and income are also factors that seem to play into the racial disparity in credit scores. Again, the relationship between unemployment and low incomes with credit scores isn't terribly surprising. Having sufficient income to pay bills on time is sort of a necessary precursor to having a good credit score. So it makes sense that in areas where there are higher rates of unemployment, there are also lower average credit scores. The relationship between unemployment rates and minority presence also isn't a huge surprise because we already knew that in 2012, white Illinoisans had an unemployment rate of about 7.6%, whereas African Americans had a rate of 22.4%, and Latinos had an unemployment rate of about 12%. We also know that white Illinoisans have nearly twice the median household income that African American Illinoisans have, and Latino households also have slightly or significantly less than their white counterparts. So our analysis here sort of just illustrates that relationship in a slightly different way. So here we see the graph that illustrates the same relationship between race, credit scores, and low income rates. In areas with higher rates of low income, the average credit scores are lower, and there is a higher minority presence. So while many of these relationships don't come as a huge surprise, looking at all of them in relation to the disparity in credit scores helps us to understand just how complex this issue really is. So we're looking again at our example neighborhoods, and we can see some more shocking differences. The unemployment rate in Lincoln Park is only 5%, while in Inglewood it is 25%. Similarly, in Belleville, the unemployment rate is only 6%, while in Washington Park it's 26%. The low-income rates follow a similar trend. In Lincoln Park and Belleville, only 8 and 12% respectively have low incomes, whereas in Inglewood and Washington Park, it's 22 and 25%. Homeownership and home loan debt are also really strongly associated with minority presence and credit score. At first glance, the relationship between homeownership and home loan debt and credit score seems like kind of a no-brainer because in many cases a good or at least a decent credit score is necessary to secure a home loan that's necessary to buy a home. But then when you throw race into the equation, it gets a lot more complicated. So first, we know that home ownership is not an equally accessible asset. Home buying has a long history of intentional racially discriminatory activity by lenders, brokers, and communities that continue to influence home buying for communities of color. We know that African Americans in Illinois are almost 3 times more likely than white Illinoisans to rent rather than own their homes, and Latinos are twice as likely. So we see some similar relationships between home loan debt and average credit score with minority presence. Looking again at those neighborhoods that we're using as examples, we see some more of the drastic disparity. In Lincoln Park, almost half of the homes are owner-occupied, as opposed to less than 1/3 in Inglewood. The home loan debt is also over $100,000 more in Lincoln Park than Inglewood. The St. Louis area also paints a pretty dramatic picture. In Belleville, over 3/4 of homes are owner-occupied, while in Washington Park, less than half are. Home loan debt is also over $50,000 higher in Belleville. So what do all these relationships mean? Basically, they show that credit disparity and the racial wealth gap feed one another's growth. Also, without swift action, that cycle is going to continue. And the bottom line is that financial institution and government policies created and fed the racial wealth gap and the gap in credit scores, and policies can reverse it. And this is just a little bit of information about the reports that we're releasing today. This is the Trap by Credit report, and then the next slide is, again, a credit report, both of which will be available both on Impact's website and IABG's website.
Great, thank you so much, Lindy. So we, I should note that a lot of that, or that sort of community level data is in the Trap by Credit report in the appendix there, so you can pull your community and get a better sense for what the numbers are there. IABG and Heartland Alliance are also happy to come out and walk through those numbers with you. So we want to get into some of the solutions. There's obviously a very deep story here. We talked a little bit about the history, policies that have contributed to the gap. And so we'd like to move to talk about solutions and then get into a discussion with you guys and answer some questions. So I'm going to turn it over to Kristen at Justine Peterson, who's been working on products that really address these types of disparities and help people build credit.
Great, thank you, Lucy. Welcome, everybody. I'm excited to be here today. This is Kristen Schell from Justine Peterson. I think there are a number of solutions that are important to closing the racial wealth gap with regards to credit. I think that there's one that I particularly want to highlight, and that's access to safe and affordable credit building products. I think that financial institutions, CDFIs, and nonprofits have made strides in the field of creating safe and affordable credit building products over the last couple of years. I do still believe that there's a lot of work to be done and that there needs to be more access to low and moderate income families to these safe and affordable credit building products. One of these solutions could potentially be that the federal government, through its Assets for Independence (AFI) program, could consider a credit component to the IDA that it already funds. So while IDAs are awesome asset building products, they currently have no impact on credit. So even though many clients purchase credit sensitive products with IDAs like a home or a car, they don't affect the credit score, so there's no credit building component at the conclusion of the savings program. So I think that having AFI include a credit component to the IDA would be a great solution. I also believe that one of the best ways, a great solution, while there's numerous of them, again, is to have low, moderate income families be able to access small dollar credit building loans and particularly even secured credit cards to help them to build credit. Why is this so important? It's important because in order to increase credit scores, we see that there's this huge disparity with the racial wealth gap and the credit scores. But in order to really increase credit scores, you need to have good lines of credit that are active on your credit report. Many low, moderate income families just don't have access to these safe and affordable trade lines, these active lines of credit. If they do, if they have a trade line or a loan, it's usually a high interest loan. It's probably could be like a car loan that they're paying very high interest, maybe a lot of fees on. And so it's financially not safe and affordable. And so having access to these safe and affordable loans is really what's going to help build credit and help low, moderate income families become financially stable. One of these programs that I wanted to highlight was the LISC Twin Account. And products like the LISC Twin Account could really innovate the field of credit building. So LISC, Chicago's network of centers for working families, also known as the Financial Opportunity Centers, piloted this Twin Account program and are now able to offer it to their clients. It's an innovative IDA-like product that helps clients to save and also to build credit. Participants in the Twin Account program go through an approval process and then are issued a $300 loan, but these funds are held in a locked savings account while the participants make 12 months of monthly payments, and they're about the monthly payment's about $26 a month. If the participant makes their payment on time every month, so they have to make 12 payments every month, not 12 payments every month, but 12 payments throughout the year. The due date for these payments are the 15th of every month, so they need to make them by the 15th of every month. Their payment then gets matched, so this is where we see this kind of variation of the traditional IDA. They make their payment on time and it gets matched every month. So participants that make all their payments on time finish the program with $600, $300 from the loan, and then $300 in match funds. It's called the twin account because it's two accounts. It's a credit building loan. It reports to the credit bureaus. It helps the participant to build credit. And then it's also a savings account. It's locked, so the client is making payments, and those payments are going into their savings account. At the end of the 12 months, that savings account is unlocked, and the client has access to those funds. The LIST twin account currently, Chicago, LIST Chicago, the Financial Opportunity Centers piloted the program in 2012 and 13, and then LIST National opened up the program to other financial opportunity centers that are part of the national network. Currently, the LIST twin account is available in 6 states. My organization, Justine Peterson, who owns a CDFI called Great Rivers Community Capital, is licensed to lend in each of these states, and we process the twin account to the Financial Opportunity Center. So currently we're lending in Illinois, Michigan, Minnesota, Ohio, Texas, and Massachusetts. What continues to be innovative about this product is that the match funds are supposed to be used for credit building purposes. So if a client were to finish out the twin account loan and then have no other lines of credit, their score is just going to plateau or at some point go down to a no score. So the ideal use of the match funds will be to open a secured credit card to continue to build credit. Secured credit cards are another great way to continue to build credit. Because it's a continuous product that really never closes unless a client closes it, a consumer closes it, or if they default it, then the financial institution would close it. The impact of the LIST twin account, for those that are unscored, there's a huge population of clients that are unscored. So they come in and they actually have no credit score at all. Actually, 40% of FOC clients, Financial Opportunity Centers clients, are actually come in with no score at all. So for a client that opens the twin account with no score, at about 6 months, we're seeing the increase to about a 676. For those that are scored, the average increase is about 20 points in 6 months, although this data is really a small group as we're just starting to see clients roll into that 6 and 12-month mark. So I think we're going to see scores increase even higher. The highest we've seen some of the increase is 87 points in 6 months. Seeing a credit score increase is powerful and can have really great results for participants. And it's not really just about the score, but an increase in score is going to mean a decrease in expenses. So some of the successes that we've seen from clients is that they've been able to lower their interest rates on car loans or better their premiums on car insurance rates, which decreases their expenses. So as their credit score is increasing, their expenses are decreasing and saving them money in their budget that they can put aside to saving or further asset building purchases. Many of the clients in the LIST twin account have even seen just basic financial successes, like because of doing the twin account, they're able to now open a bank account, they're able to access other small dollar loans through their financial institution, including a bank or a credit union. And as stated before in just the following slide is that I also think that secured credit cards are another great credit building tool. So for financial institutions that might not want to have a loan program, another tool would be a secured credit card. Following the Cards Act of 2009, we really found that it's very difficult for low credit score clients or no credit score clients to really get access to an unsecured credit card, especially one that has good terms, so lower APR, lower fees. There are some unsecured credit cards that are out there, but they're higher APRs, higher fees, almost predatory-like. And so, so many financial institutions are starting to offer secured credit cards as they see the need for credit building tools. we do tend to see that secured credit cards can increase a client's score higher and faster if used correctly, which means that the client pays on time and that they keep their balance under 30% of their credit limit. You know, when offering a secured credit card, it's important to message to clients when using the credit card that it's not a consumption tool. So we're not looking for low, moderate income families, or really any families, to open a secured credit card and then get into more debt. We want them to use it for something that's already part of their budget, like a $50 cell phone or a small utility bill. This way they aren't incurring any extra debt, and they can be experts at really this credit building game and have a very high, almost to a prime credit score where they can access great asset building programs. I think that's it that I wanted to highlight. I look forward to questions as we kind of finish through the rest of the policy and solution section. So I am going to hand it back to Lucy now.
Great, thank you so much, Kristen. That was great. And I think we do have a bunch of questions about the product. But before we get into that, I do want to talk about some policy solutions. So both at the federal level and at the state level. So there's certainly a lot of opportunities when we to change policy. When we presented the data in communities across Illinois, this was one of the questions that we posed is, okay, what is the policy solution? What are the, you know, what are the barriers and challenges that people are facing when they try to build credit and also build wealth? And so these policies really include responses to that. So at the federal level, what we'd really like to see is expanded opportunities for positive credit reporting. So currently, when you make on-time utility payments or on-time rent payments, those are not automatically reported to the credit bureaus. However, utility companies do report late payments. So the negative action is reported while those on-time payments and those positive actions are not reported. So what we'd really like to see at the federal level is that they authorize this voluntary full file reporting of utilities, rental payments, and even you know, those telecom or you know, when you're paying your cell phone bill. Another federal level policy is we'll really like to see funding for credit builder loans like the ones that Kristen spoke of. The asset building community and the movement is still really young. And initially, and I think still, you know, there's definitely a place for individual development accounts, and we're lucky that we have the Assets for Independence program at the federal level, which provides funding for these match savings accounts. But as we're seeing new products are being developed, like credit builder loans, and there's a real opportunity to have a bigger impact on individuals that are trying to both build savings and build credit. So what we'd really like to see is that a shift with AFI, with the Assets for Independence program, to add, in addition to IDAs, but to add a credit support for credit building loan products. Currently, when people save through an individual development account, they are not building credit simultaneously. However, they are building some savings. But at the end of their program, they are expected to take out a loan or in order to pay, you know, or they're expected to use that savings towards education or towards home ownership or towards a business. So likely they're also taking out another loan. If they're not building their credit at the same time, then they're still paying more for that loan than they should be. So we really see a lot of potential with credit builder loans, and we'd like to see some changes at the federal level. So this is another policy recommendation that's part of this report. Finally, at the federal level, what we've identified as sort of another final policy recommendation is really strengthening reforms on predatory lending products that can really trap people in this cycle of poor credit. there's certainly been efforts every year to cap interest rates. I think where we're seeing the most likely movement on this is some reforms coming down from the Consumer Financial Protection Bureau, which is expected to come out with recommendations on, which is expected to come out with rules related to payday lending. So we're looking closely at that. We worked with our coalition members last year to put recommendations forward to the Bureau. And so when those come down, we'd like to take those and see what impact we can also make at the state level. So speaking of state level policy, Heartland Alliance has a policy and advocacy team, which I mentioned I'm a part of, and we really focus on state level policy change and have a full agenda, which includes asset building policy. And so we'd like to continue to build out credit building policy and what really, and better understand what really falls into that. But what we're looking at, what we've recommended in the reports and what we got, what we heard from the roundtables we did with communities is what you see here. So we really want to see expanded access to safe small dollar loans. I mentioned this is listed under state policy, but there have been some good efforts at the municipal level, and this is something IABG has worked on in Chicago, and we'd like to see other communities take on. But the city treasurer's office, the city treasurer in Chicago created a linked deposit program, which really supports financial institutions that are interested and willing to offer a small dollar loan, an alternative to a payday loan in their communities. We'd like at the state level to see stricter enforcement of restrictions on employment credit checks. The state of Illinois prohibits employers from checking an applicant's credit report unless that person is applying for a position that requires them to manage money. Yet we continue to hear, and we heard it in the roundtables, is that residents' poor credit score is preventing them from finding employment. So we're recommending that the state better enforce these laws to increase opportunities for workers. Third, this connects to the federal level, but working on predatory lending reforms moving forward, including reforms to auto title lending, which we're seeing an increase in across the state. And finally, I guess two more. One of the big things is expanding access to savings opportunities. So this year, IABG is working with a number of our partners at the state level to expand access to retirement savings opportunities. While this doesn't directly relate to credit scores, we believe that we need a holistic approach when we're thinking about wealth building and thinking about addressing the racial wealth gap. Currently in Illinois, more than 2.5 million workers don't have access to I should say 2.5 million private sector workers don't have access to an employer-based retirement savings, which means that more and more workers are retiring into poverty. They're over-relying on Social Security. And this legislation, which we have been advocating for at the state level, would expand access to retirement savings accounts for all workers. And if retirement ties in really to somebody's life cycle and their efforts to build wealth and to really build financial security when they become seniors. And finally, I should say, another bill I just want to mention because it is a priority for Heartland Alliance and is mentioned in the report is raising the minimum wage. None of these bills alone address some of the disparities that we spoke with in the report, but people's income has a huge impact, and the fact that so many workers in Illinois are working full-time but still living in poverty is really shocking, and these bills would raise the minimum wage to $10.65 over 3 years. So there's just kind of a recap or an overview of what we're working on, what we hope to be working on moving forward, and some of the recommendations that came out of the roundtable discussions that we had with communities. As I mentioned, this is credit credit building and credit scores is a new bucket area for IABG, and so we're really continuing to look for feedback on what are some of the policy solutions, and so we'd love to hear it either from you today or ongoing as we work on some of these policy solutions. So we are going to open it up now for questions and answers for a Q&A session, and I'm going to turn it over to our colleague Ethan Brown, who's going to kind of moderate this session for us.
Hi everyone. Thanks, Lucy. This is Ethan Brown with IABG. So we have already gotten several questions from the audience already. Everyone attending, if you have an idea, just send it through a question or chat box or raise your hand, and hopefully we'll get to you. So one of the first ones we got was, let me see, what are some things being done outside of Illinois for credit building? And I think we're going to have Kristen Shell take care of that one. Let me get you unmuted. There you go.
Sure. So I think the question is probably like what other, so there's some great other credit building products that are going around that many organizations, nonprofits, and CDFIs are starting. And I can highlight a couple of them. You know, at Justine Peterson, we do offer credit building loans. We piloted a secured credit card program, which were available in St. Louis and Illinois. So we have our programs. Another one, Mission Asset Fund in San Francisco, has lending circles. So similar to kind of the Green Bank model, but the Green Bank model doesn't report to the credit bureaus, and so the Mission Asset Fund Lending Circle is actually a credit building loan that reports to the credit bureaus. It's currently available at 16 nonprofits in California and then 6 states in the U.S. So there's some other nonprofits that are working on that program. It's pretty an innovative program. In Chicago, Axion Chicago does micro-lending to small businesses, anywhere from $500 to $50,000, and these loans report to credit bureaus. So these are all kind of credit, building. They all help people to increase credit scores. Any product that reports to the credit bureaus that's safe and affordable is, really a good product that can help people build scores. Credit Builders Alliance, for those of you that are familiar with them, their website is creditbuildersalliance.org, has some great resources. They have a credit building loan site which highlights some of their members' programs and some credit building loan products that their members have. They also have a secured credit card page that kind of walks organizations through like what to think about when starting a referral program to secured credit cards or thinking about offering one themselves. So Credit Builders Alliance can have some good resources too as well.
Okay, thanks, Kristen. That was really great.
You're welcome. Great.
So let me see. I've got another question here. I really like the racial wealth gap timeline. Is it okay to use it in my own work? I think we'll have Carl or Lucy handle this.
Well, we're really glad that you like the timeline. Carl spent a lot of time researching and thinking through how to make it most accessible to people. We would love for people to use it. They should feel free to utilize it in any way. It's a living, breathing document, so we imagine that we still have a lot to add to it. We aren't aware of other groups that are currently doing the same thing. I know United for a Fair Economy about almost probably 10 years ago had a timeline that I think maybe didn't have as many policies that was helpful to get us started, certainly. And we are right now thinking through kind of building actually a curriculum that goes along with that. Carl has heard back from some different teachers here in Chicago that are interested in using it, so it's something we're exploring as well.
So I'll put a point in there. Yeah, I'll say one quick thing. This is Carl again. Part of this is it's a fairly new tool. I think there wasn't a lot during the research. I didn't see a whole lot of things out there. So part of the importance of this is that input is really important. So if you'd like to maybe use this or kind of see it expand or maybe have suggestions of ways it would be helpful for your classrooms, there's that comment box underneath the timeline that if you could kind of submit just information and I can be in contact and kind of work through maybe how we can coordinate and kind of get that out there more.
Let's see, I believe Dory Rand has her hand raised. Dory, do you have a question?
Hi, yes, thank you. You know, Woodstock Institute worked with IABG back in September of 2010 to do an earlier version of the credit score report called Bridging the Gap, in which we also documented extreme disparities in credit scores and saw that the low credit scores were disproportionately concentrated in communities of color. And I wondered if you did a look back in the current report to see if that trend had improved or gotten worse since the 2010 report.
Well, one big difference between you know, that research and this research is first that that was focused on Chicago or Cook County or Chicago. I'm sorry, I can't remember. But ours tried to look more at the state as a whole to try to understand what it looks like even outside of Chicago area. So, you know, in some ways the research was a little bit different, but we didn't, you know, the scope of this report didn't quite go into looking back and making that comparison, partially because of the different geographic areas. But, you know, that's a great idea of something we should, you know, look into in the future.
Okay. Let me see. The next question we have here is from Erica Singleton. How can we find out more information about these loan savings accounts in Chicago? And let me pass that along to Kristen. Hi, Kristen.
Yeah, so to learn more about I think the list twin account, which is the question, I think my contact information might be at the end of this slide. You can contact myself or at the end of the presentation. I think we'll have that up. You can contact myself, otherwise it's kshell@justinepeterson.org. Or go to LISC Chicago's website, and you can see all of the financial opportunity centers or their Center for Working Families. They're used kind of interchangeably. The sites that are available and which organizations are utilizing. All 11 financial opportunity centers in Chicago have access to the twin account and are getting their clients enrolled in the process.
And thanks, Kristen. This is Lucy. We do have a document that provides a map of where those locations are across the city that was provided to us by LISC Chicago, so we can include that in the materials that we send out as well. And you're right, Kristen. We will. Your contact information we can actually put up now. If you want to go to the next slide, we'll just.
Oh, sure. There you go. Okay, thanks, Kristen. The next question we're going to have spoken aloud. It's by Michael Doherty out of Champaign. Let me go ahead and unmute you real quick. Hi, Michael.
Yes, can you hear me?
Yes, we can. Thanks.
Okay, that was some great data you had. Is it possible to get that kind of a breakdown on our local community in regards to the credit scores, the education level, the debt, all those other things?
Yeah, so in the appendix to the report, we do have that broken down by county. We do not have in the appendix by even more, smaller demographics, partially just because, zip codes are just not super intuitive as to where they are on the map. But, if you have specific questions, you can probably send them to me and we can talk about it. But, we have in the appendix of the report broken down by county.
Great. County is a great way to start. Thank you.
Great.
And Michael, we'll actually be in Champaign on, is it Wednesday?
Yes.
We're going to be providing a one-pager for you guys on that.
Okay, I'll be there.
that's also a shout out to others who might be interested in us doing that. We're happy to come to your community.
Thanks, Michael. Let me see the next question we have here from Catherine Okoro. What CDFIs in Illinois offer these secured credit card and loan accounts? Is there anywhere to gain access to a list of the institutions that offer them? Any of these low-cost secured programs? I believe Kristen might be able to handle that, and I think you might talk about the Credit Builders Alliance, right?
Yeah, so too, a couple of places where I find information about credit building products would be the Asset Platform. I believe it's assetplatform.org. Has a great counselor tool for credit unions. They have a credit union locator, and you can type in your address and then find what credit unions are in the neighborhood and what products they have. So secured credit cards, small dollar loans, payday loan alternatives, that kind of thing. So the Asset Platform has credit union information. The CDFI funds, their website, you can find out which CDFIs are in your neighborhood, although not all CDFIs do credit building. So just that's kind of something to watch out for. Credit Builders Alliance, if you look at their website, they have a member locator, and not all of their members offer credit building loans, but it's a good place to start. And then on the City of Chicago Treasurer's Office, they have a program locator, so you could see who offers, financial coaching, credit counseling, that kind of information. So that's kind of where I would start. Unfortunately, there isn't one comprehensive site that has all of that information, although I think it's something that many groups are looking into having.
Thanks, Kristen. And when we send out the notes from the call, we can include some of links to some of the resources that you mentioned there, if that's helpful for folks.
Okay. So the next question we have is coming from Shirley Griffin. Shirley, I'm going to be unmuting you in a moment. And if you could read your question aloud. Oh, well, that's not working out so well. So I'll just read it out myself. To what extent does IABG's work with existing financial services organizations to promote financial literacy and financial planning?
So this is Lucy. I can take that one. So IABG, as I mentioned, we're a statewide organization. A large percentage of our coalition members are organizations that are providing some type of financial empowerment service, whether it's financial education, financial coaching, doing a match savings program, doing a credit building program. And they really, the work that they're doing on the ground really informs our policy agenda, so it's really crucial for us to have their voice at the table and to be learning from them. We are always looking for new members and for new voices, so you can join the coalition on our website. We also do, one of the things that we, in addition to asking for feedback on our policy agenda, we do ask for feedback about the types of technical assistance organizations that are providing those types of services need, and we offer web seminars throughout the year that address those topics. So over the last year, we've done webinars on prepaid cards, on
the Bank on Chicago program.
Yeah, Bank on Chicago.
The IDA program, where you brought in someone from Assets for Independence.
Yeah. So we continue to do those, and again, are always looking for feedback on those as well. And then finally, we do have a statewide conference every other year, and we'll be announcing the date for our next conference shortly, which should be in the fall of 2014.
Yeah. Okay, so the next question I have here from Kendall Reed. Can you apply for the LISC account online? And let me go ahead and give that back to Kristen. Hi, Kristen.
Hi. Yeah, at this point, you cannot. You actually have to go into one of the financial opportunity centers and apply with a financial counselor, which makes the product so innovative because it's not just about giving a credit building loan, but it's also you're meeting with a counselor who's reviewing your credit report and following you through the 12 months. Although I'm all for innovation and would love at some point to get it online, but at this point it's available through the Financial Opportunity Center sites.
Thanks, Kristen. Great as usual. Okay, so the next question I have here is from Clonetta Trotter of Quad Communities here in Chicago. I actually spoke with Clonetta prior to producing this report, and she provided a lot of really great feedback. And her question here today is, how do we as a nation reverse this prejudice to reduce or eliminate the racial wealth gap when so many institutions and organizations profit from poverty?
Wow, that is a big question. So I think that a couple of things. I don't think I have the answer to that question. Two, I think that it's really important for us to continue to do education around racial inequity and what it really means, what some of the causes are, and what some of the solutions are. So we have been really lucky to be working with communities across the state. So this past year we did about 5 racial wealth gap roundtable discussions across the state to just increase awareness and to start brainstorming about solutions both at the community level, state level, and the federal level. And you know, I spoke about how a lot of that contributed to this report. I will say we're also lucky to be part of to work with groups across the country that care about these issues and are working for solutions to the racial wealth gap. We are lucky to have the opportunity to continue to learn from them and to be part of this larger movement and to really think about how to raise our voice. I think obviously just one report or one organization isn't going to be able to do it alone, but working together, we've found that we can have some impact and that we are having some policy successes.
Thanks, Lucy. That's pretty tough question to answer just because it's such a big issue, and I mean that's what the whole report is in the end geared to address. So we have another question here from let me bring it up, from Thurman Smith, which I think is important because it sort of talks about the future of credit building solutions. So Thurman asked, some of the credit builder solutions come with grants or other subsidies. How sustainable is that model, or do we need to infuse more capital to make this a more sustainable approach long term?
And Kristen, is this something that you've thought about?
Yeah, I can take this call or this this question, although I don't know if I have the exact answer. But I mean, you know, credit building programs, whether for nonprofits or for CDFIs or for financial institutions, are not money-making programs. You know, for financial institutions, it really is to get those clients into other products. So they, you know, start off with a credit building loan and then they move into a car loan or a mortgage loan or even just a bank account. So, you know, that's kind of the idea, you know, for nonprofits. They do need to be subsidized by grants. They don't make money, you know, for that nonprofit. I think there's still a lot of work to be done to look into kind of that sustainability model and how can nonprofits become sustainable on credit building products. The Aspen Institute has been doing work on this as well.
Thanks, Kristen. Again, great. Let me see. So next question we have here. How do we close those education differences that Lindy spoke of?
So this is Lucy. I can just talk about some of the work that we're doing. So one of the big policies that IABG and Heartland Alliance works on is around universal children's savings accounts, often called college savings accounts or children's development accounts. And a lot of the work stems from research that shows that a child that has a savings account in their name that's specified for higher education is 6 times more likely to attend college. If they have even only $500 in that account, they're 4 times more likely to complete college. So there's a movement across the country. There's been efforts here in Illinois to look at that. We're excited to see more and more progress in some other communities to create these types of accounts. Probably the first one and maybe the most well-known is kindergarten to college, or K to C, in San Francisco, which opens up a savings account for a child that enters kindergarten and provides a match savings for children that are enrolled in the free and reduced lunch program. One of the most recent ones would be that in Nevada. The state treasurer there recently announced that she would be opening up a 529 college savings account for every kindergartner in Nevada with a $50 seed investment. And that's actually coming from previous investment earnings from their 529 account savings program. Here in Illinois, IABG led efforts to create a children's savings account task force a couple of years ago that came out with recommendations of how to create a similar program in the state, and we are currently working on trying to implement some of those recommendations and advocate for a program here in our state. So we'd be happy, I think, offline to talk more about that. I think it's a little bit separate. And then there's definitely efforts at the federal level. The Consumer Financial Protection Bureau has been looking at those for-profit universities and loans associated with that industry and the impact that they're having, especially on low-income students. And I think that's a key component when we think about access to education and credit scores. So we are out of time, so I think there might have been a couple more questions that came in through chat. So if that's the case, we will follow up in the materials that we send out with those questions, or we'll follow up with you individually. But I do want to thank all of our presenters today. I also want to thank the organizations that really helped us put this report together. That includes Justine Peterson, LISC Chicago, the Credit Builders Alliance, and a number of credit building counselors that have been working with LISC Chicago and have really provided a lot of insight. There will be a survey that will pop up, and we love your feedback. If you have additional questions after this, please reach out to us. We're more than happy. And again, like I mentioned, we would love to come and present to your organization or your community members about some of the specific data that we have for your community. And we hope that you'll check out the report more fully. And we look forward to talking to you again soon. Thanks, everyone, for joining.